Welcome to the December 2020 monthly market report. This is for you if you are a real estate agent or financial advisor interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and I'm excited to share market data with you so that you can make an informed buying or selling decision or help your client do the same. Today, we'll talk about that nagging question we all have on our minds. Are prices going up too fast? Can we sustain this pace? We're also going to get an update on forbearance and can it lead to a housing crash? I'll also touch on projections for 2021, but not before I take a quick jab at the fear-mongering media. So let's get started. I want to kick off with this metric, which I cover just about every month, and that being NAR's Housing Recovery Index. The four components of this index are demand, supply, price, and time on market. As you can see, we've settled into a very nice purchase market. Of course, we could do with some more inventory. That's the only negative, but everything else is looking pretty rosy. So why is this important? Well, the natural question to ask is, are we overheated here? Are prices going up too fast? Is this market sustainable? Or are the people calling for a 2021 housing crash in fact correct? I'm going to come back to that in just a moment because firstly, I want to update you on forbearance and where things stand. Taking a look at this chart, we're still down dramatically from the beginning of the pandemic, although we have seen those numbers tick up slightly over the last few weeks. So like we did last month, let's take another look at what's happening after people come out of forbearance. Here's the most recent data from the Mortgage Bankers Association showing what has happened as people exited their forbearance plan. The green, or 54.6% of people, paid their forbearance plan in full and are current on their mortgage. These are most likely the people that opted for forbearance out of an abundance of caution, but ended up not needing it. So as you look at the blue, this refers to people that didn't pay their forbearance plan in full because their lender most likely allowed them to make their missed payments at the end of their loan instead of now, or put them in some kind of a payment plan. And as you look at the red, 12.8% have not yet entered into a loss mitigation plan and only 1.9% are in a distressed sale situation. So why is that important? Well, the red are the ones that could turn into potential foreclosures, but we've spoken about this in the past, about the healthy state of equity homeowners have in today's market. If you recall, 42% of homes are owned free and clear and less than 8% of homes don't have 10% equity. In other words, if people run into trouble with making their mortgage payment, they have sufficient equity in their home, which gives them options and certainly makes them gives them a vested interest in selling at the right price, unlike in 2008 when so many homes were upside down and sellers didn't care what their home sold for. In last month's report, I pointed out that across the country, there's only 2.7 months of inventory available. So if we do get distressed sales from people currently still in forbearance, it's nothing that the market won't be able to absorb. The chief economist at NAR said exactly that. Any foreclosure increase will likely be absorbed by the market. It will not lead to any price declines. Now, if you'd like your clients to be informed on what steps need to be taken to request forbearance, forward them this video and direct them to this slide, which is the CFPB's steps to ask for mortgage forbearance due to coronavirus. So back to the question, are prices rising too fast? Can we sustain this in the market? I'll start with a quote here from the Case-Shiller report that was most recently published. It says, housing prices were notably, and I'm tempted to say very strong in September. The National Composite Index gained 7% relative to its level a year ago. That's 7% appreciation. Our 3 monthly readings since June of this year have all shown accelerating growth in home prices, and September's results are quite strong. So we keep hearing the market is hot and we're seeing it across the country. So is this something to be worried about? What's going on with home prices and can we sustain this type of appreciation? Let's get a little perspective by going back in time. If we look at compound annual home price appreciation, going all the way back to 1991, we see the average is 3.8% in annual home appreciation. If we look back to 2012, we see that's been considerably higher at 6.1% appreciation. So that's quite a jump in recent times, although it's not surprising since real estate prices in 2012 were still somewhat depressed to begin with, coming out of the Great Recession. So hypothetically speaking, if we were to start at the year 2000 and use the historic appreciation of 3.8% annually, where would that put us today? Of course, this is not reality. The market doesn't behave that way. But if we then compare it to what actually happened, we can see that the actual appreciation is outpacing the historic appreciation this year. Maybe something akin to 2003 or 2004. So that's certainly something to keep our eye on. And the reason we find ourselves here, at the risk of sounding like Captain Obvious, is inventory and home prices and what has happened to both of those over the last 10 years. If we've got inventory and home prices moving in opposite directions, of course fueled by low interest rates and, as it pertains to 2020, the pandemic. So where to from here? I think the chief economist at NAR hits the nail on the head. He says, such a frenzy of activity reminiscent of 2008 raises questions about a bubble and the potential for a painful crash. The answer? There is no comparison. Back in 2006, dubious adjustable rate mortgages taxed many buyers' budgets. Some loans didn't even require income documentation, and today, buyers are taking out 30-year fixed rate mortgages. 14 years ago, there were 3.8 million homes listed for sale, and home builders were putting up about 2 million new units. Now, inventory is only about 1.5 million homes, and home builders are underproducing relative to historical averages. So when we were back in the housing crash, oversupply and irresponsible lending led to a lot of challenges in the market. Today, however, we're in an undersupply scenario in a very different lending environment across the country, and we're seeing appreciation. So this is certainly something to keep an eye on, but my money is on 2021 being status quo, despite headlines like this one. Americans' mortgage debt soars to a record $10 trillion. This is just another instance of the media doing what it does best. This will have many people saying, here we go again, prices are appreciating at an unsustainable rate, mortgage debt is soaring, here comes the crash. This point of view completely lacks context. Mortgage debt will inevitably rise over time as more homes are built and as those homes appreciate and as those homes are sold and so on. So what CNN should be talking about is debt service ratio. Can people afford this debt? And they should have crafted a headline around this: the household debt ratio for mortgages as a percentage of disposable income. In other words, how affordable is a mortgage today? And as we look all the way back to 1980, we can see that there has not been a time, percentage-wise, when less household income has been required to afford a mortgage payment. Why is that? Well, that is the effect of lower interest rates and rising wages. And yet another reason there will not be a crash in 2021. Now, I don't know why the media doesn't publish that sort of data. Perhaps it's too much good news for one serving. So as we look forward, I think we're all ready to rid ourselves of 2020. So let's talk about 2021 projections. Here is what the chief economist at Indeed had to say. Above all, the 2021 outlook hinges on the course of the coronavirus. Both the recent virus surge and the election make government emergency relief more likely. That's a reference to more stimulus, by the way. Next year will also start to show where the two big pandemic shifts will endure, from services to goods and from in-office to remote work. Even small shifts in these trends, if permanent, could cause big changes in how businesses hire, how job seekers search, where people live, and how much they earn. So I certainly don't have a crystal ball to say what's going to happen with that, but it sure will be interesting to see how it all shakes out and how the newly developed vaccine affects those shifts. As far as mortgage rates go, Freddie Mac has come out with their projections through the fourth quarter of next year, and this is in slight contrast to the projections from the Mortgage Bankers Association. If you recall, last month the MBA projected a slight increase in rates, nothing dramatic, but Freddie Mac is saying that we're going to stay at around 3% for a 30-year fix. And whether we're in the high 2s or the low 3s, as I said last month, this is exactly the fuel we need to sustain a healthy purchase market. And how healthy will that purchase market be? Well, here's what the chief economist at Realtor.com had to say. We expect sales in 2021 to come in 7% above 2020 levels, following a more normal seasonal trend in building momentum through the spring and sustaining the pace in the second half of the year. While home sales are expected to lose some momentum over the last months of 2020, a shallower than normal seasonal slowdown creates a higher base of activity leading into 2021 that is roughly maintained for the first half of the year as vaccines for the coronavirus become broadly available to the public and economic growth reflects the resumption of a more normal pattern of consumer spending. Home sales gain even more in the second half of the year. And of course, what's driving this interest from buyers, as we have spoken about before, is that many people's needs have changed due to the pandemic, and we are now experiencing what some have referred to as the Great American Move. So to wrap up, I'll leave you with a quote from the chief economist at NAR, which says, "This winter may be one of the best winters for sales activity. On a winter-to-winter comparison, this could be one of the best breakout years just based on the fact that pending contracts are at such a higher level." So 2021 in all likelihood will be a spectacular year for purchase activity. I invite you to check out this monthly market report, which I put out in the second half of each month. And I trust that if you're a realtor or a financial advisor, The information here will help your clients make informed decisions, and if you are a buyer or a seller, consider yourself informed. So that's a wrap for the December monthly market report. I appreciate you listening. Forward, subscribe, share. I'll be back next month. But before I go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there is room for improvement. Thanks again for tuning in. Bye for now.